SMF, MMTs, S&P 500 index options are tradable for huge, extraordinary amount of gains at extreme tops. When the S&P 500 on our homepage, you'll go and you'll find out that back before May 1st started that we were going to have a nice big healthy correction on the S&P. Now, when the S&P 500 was over here at 1370, that's 70 points above that $1,300 put option, because this was a July $1,300 put, that at the time that this was making its highs, we were making our lows. This was making the highs in the overbought, and the put option here at the 1300 was making its bottom. So we went from $12.50 a contract to $50 a contract. When we came all the way down in that reversal to the S&P 500 and we hit that bottom, you can clearly see that as we hit the bottom on the 200-day simple rising moving long-term moving uptrend, that the S&P wasn't going to break lower, that we had put in the top, and that was when you would have been short the S&P using S&P 500 put options. And how do I do those, and why are they very important at market top reversals, and how do you trade it? They were totally deflated here. They used to be way over here. These contracts were close to $60. They came all the way down to $12. This is the deflated side of the market on the short side, put side of the S&P. We went from this point, from this big correction, it started over here, but then it really broke down here. You can see how these put options went screaming up here to $50-some. And that's what the S&P 500. Now, on the foot side of it, you can see that during that correction that you broke higher here on the put side. At the very same time that we were putting the bottom here in the S&P and we rallied up, but we broke out here, you can see that now, right here, where my pointer is, that those put options are really deflated back to 385. So they went from $50 down there. Then you can clearly see that as the S&P 500 was breaking higher in its breakout here, that all the put side lost its value here. Here. When we put in the bottom, you lost all your value. You're deflated here now. Here, you had the 5-day breakout, and that caused that value. When I said the bear would never know when to come out, you got to know to be selling up here at the top. And you got to know that at the very same strike price, this is a $1,300 call, that we had put in that bottom. Now, let's watch this. You can see here that when the S&P did not want to break this long term, it was time to buy up and out of the money. The $1,300 call was the strike price, because this is where that resistance level was. In a 5-day period that we experienced last week for the greatest bull weekly move than we've seen in a long time, you can see that $1,300 call was $7, and they went all the way up here to $43. Having 10 contracts up here would have yielded about $35,000. If you had 20, $70,000. If you had 30 contracts only, but you got to know when the S&P is going to have that reversal. Now, at the very same time, if you take a look over here, you can see very clearly here in the very same video that this $1,300 put, here it is, $1,300 put, here it is, $1,300 call, and here it is, the $1,300 call was totally inflated. It was deflated down here. It got to $7.62. And we were inflated over here. And you can see clearly, $1,300 call. You can see clearly, $1,300 put. And we can see that when the S&P 500 was doing its breakout right here last week, that this side of the market was the side of the market to be on. And what makes it nice at big top reversals, that you were deflated. Now you were deflated here, but you're a lot more deflated than you were at the original handle. Now, we've gone straight up parabolically in 5 days on the call side, and we have come down to deflated on that same $1,300 put. So this is the side of the market, Leo, that we would be looking at buying right now at a very wholesale price. Not maybe so much the July contract, but we do have a slew of contracts that are going to be set up for August, and we're going to be going into the earnings season. The lesson to be learned, my friends, is that every MMT, because you weren't here on the last market top. You weren't here when we called the top. It's on our stockmarketfunding.com homepage. Just simply go look there, fetch the video, and see our analysis, and this is why the put side of the market was going to work. When we didn't break the lows on the S&P and we started to break higher, we were going to buy we bought the $1,300 call. That's up and out of the money now, because this was a major resistance level. And when we cleared it, it kept running. And here is the call contract. This is the call contract, 5 days in a row, straight up there. Okay, they're not totally inflated again. They were inflated at $70-some a contract. Hell, they took out all the premium down to the bottom, right along with the bottom of that S&P. They're identical. You put the bottom here, as we said, short term, this market was totally oversold. Why was it totally oversold? Well, that's your due diligence to get on that stockmarketfunding.com homepage and start doing your due diligence. And what is that? Look at our analysis before the fact. And the thing about it is, we got so oversold on the S&P in a short time frame that right here, we were hitting on these bottoms over here. We are 11% DS. When we were overbought, as we told everyone about the short, you were 91% overbought on a daily, and you were going to come down. And we did weekly analysis as well. But when we got down here to the bottom, and this is all public standard technical analysis where hedge fund managers, institutional managers, and fund managers make their decisions. They have no other way to make decisions. You're much smarter than they are in this school. And when you were at that extreme, we were short-term oversold and we broke higher, and that meant that this $1,300 call up and out of the money, which was 30 handles above the strike price, which was very cheap at the time, that when this didn't want to break, this was deflated and it was time to be on this side of the market. And 10 contracts pay a lot of money. For a lousy $8,000 investment, you just clocked 35 grand. That's the reality with the 5-day breakout over here on the S&P. And at the very same time, the $1,300 put, which was in the money now, $30 in the money now, has come tumbling down to very extreme deflated prices. We're going to be going into the earnings season, and people are going to have to deal with that. We are short term on this S&P right now on a daily level from its breakout. We are 86.98%. That means we went parabolically straight up. Great long move. When they don't want to put the bottom in, summer rally, seasonality, everything was kicking grease, you name it. It's about how that bottom wasn't going to go lower. And it was about how to transact this $1,300 call up and out of the money, Leo. And it's very important that these opportunities, they're not here every single day like these are. They could come out of a year. You might get 3 great ones that are ready to have great transactions that you can hold from 3, 5, 7, 10-day periods. And that when the exuberance got back in, these contracts can get back over here. And once again, my friends, what we're going to be looking at is this right here. MMTs, these are calls and put strike prices in here. You may want to take a screenshot of these. We're going to have you load these in your InstaQuote, and we're going to put alarms on these. There's some 8/20 August calls and puts in here that we're going to be dealing with. And here are the upcoming July expiration as we go into earnings that start on July 11th. And what we're going to do is we're going to monitor inflated, deflated. inflated, deflated on the August and shorter term trade now, because when you got the amount of exuberance, and these are the strike prices here now. I'm going to move this out of the way. And I want to make it clear, MMT, that when you take a look, I'm going to get all three of these charts in here to the best of my ability, right here. All right. Now, this is the $1,300 put, right here. There's my cursor. Let's move that over. Up here is the $1,300 call. And basically what we did yesterday is we put in the 1340 put. Why? Because, let me show you why, MMT, is that, yes, this one's extremely deflated, but now that in the money put options have come down on that rally up now. So here's the rally in the S&P, and this 1340 put was deep in the money. Now look at the premium over here that they have taken out. Look at that inflated $80 on the high when we were putting in the extreme bottom on the S&P rising 200-day moving average. These were totally inflated, and that call option was totally deflated at the 1300. Now, because this has come down, it's the strike price here, let us not forget, is 1340. Where did the S&P 500 close? It closed right here at 1339, right at the strike. That means that people that did not, they were deflated here, they went up about $60 a contract. 10 contracts make you about 60, 70 grand. The thing about it is, what was inflated has become extremely deflated. And you must understand cycle, bear and bull cycle trends to trade this one. Not only this one, they got sector indices, calls and put options. They've got the Dow put options. They've got many different instruments that the public will never know exactly how to trade. But you will. And you will know the difference between when I look at the put side here. Why did the put side come out? Why did it come from 80 some dollars a contract clear down here? Now, and why did, when the S&P broke higher? Because they were in the money. This is the reason why. At the time when we were putting the bottom down here and we didn't want to break below 1267, these were deep in the money. Deep in the money contracts. Okay? The 1340 puts had paid these people wonderful in this last correction right here on the S&P when we put in the tops and we said we were going to come down. We went down several weeks, and for several weeks the put side made a huge move. When we broke below, when 1370 was being put in on the highs up here, that meant that this was $30. This is a 1340 put. That was $30 below the strike price when you were buying these puts over here. And that these put options right here hit a low of $25 and made a high of $81. Huge move at that time when we had the reversal right here in the S&P 500 index. Now, having said that, as we get back over here to the core element, that this 1340 put, and we're closing at 1339, you already know. Now, this $1,300 call is just the opposite. You are $39 in the money above the $1,300 strike. And we are going to pin them up, and we are going to pin them down, and we can go lower here. I already gave prices yesterday. I'm not going to give the prices on the video. I'll give them to you individually off video now, so that you are going to get an experience that, once again, my friends, that when you hit extreme inflated contracts were overbought, markets were so overbought, these were going to come down to nothing almost. Came down to $7.62. The opposite with the big rally up in the S&P right here is that just on the opposite side, these are $39 now that they have taken out. They've taken out a lot more here. So this 1340 put, at the time that we were breaking higher, we were $40 and $50 in the money on these things. And people don't know when to come out, because Inflation is part of greed and irrational exuberance at highs, whether it's a stock equity, whether it's an index option, whether it's anything to do with the stock market at all. Human greed and irrational exuberance, you can see what happens to it. It came all the way down on this side. People never know when to get out up here. But then again, at the bottom, they don't know when to buy here either. And they don't know how to read the S&P 500 index itself and which way it's going to go. And all of that analysis here and now, learning how to trade S&P 500 index options moving forward with people in the school, these are the strike prices, and we are going to hit a bottom, my friends, on some of these that are going to be so when we were putting the bottom in, the put to call ratio was for the call side. Okay, now it's going to be that the put to call ratio and short term market tops is these can come down to $7 here, $8 still, and these can still get more inflated. But as we move forward during the earnings season in July and into August and on a daily compounded basis, we are going to be measuring where the greatest entry is going to be and where the next market top overbought market, short-term 5-day, 7-day, 10-day cycles, overbought versus oversold. We are going into what we call an overbought, short-term, overbought cycle trend. And that these contracts, starting on Tuesday, you will be watching me do the bid and the ask and learning the closely guarded tricks and the closely guarded secrets, how the people in the S&P 500 make literally millions upon millions trading the S&P 500 index. And once again, here it is now. Here it is before you now. Here is the open interest that was behind there on some of them, but here is the clue. Going to get top end heavy over here, and we're going to get deflated over here, and as we move up to key resistance levels in the S&P 500, this is going to be the S&P 500 chart, and the thing about it is this S&P 500 is going to come back up here. We ran what we call very quickly, very fast. Lots of short covering. So you got to know, just like when the bull was getting pounded, that the bear was going to get pounded. We told you that the bear didn't know when to come out, that the bull didn't know when to come out. They never do. Why? Well, some of it could be confusion, but it's been my long-term yearly cycle practice that I've been involved in this. It always comes down to the individuals stay longer than their stay is worth, and that 90% of the time is they don't know when to come out here, they won't know when to sell here, they didn't know when to come out here, and they won't know when to buy over here. And this is the thing about trading these index options: call options on equities, call options on sector indices, call option, put option, call to put ratio at market tops and bottoms, understanding the mechanics of it, understanding the truth of it. Go to stockmarketfunding.com, go through all of the indexes if you're an innocent bystander, because these are for the MMT videos. But, you know, because they are on YouTube and they're on our site, you get the gift and the way of seeing how things work. And the thing about it is that the analysis has to be done on the indexes. If you're not going to be correct here, if you're not going to know when there's a top overbought and a big long correction, and then everybody got on the S&P when it didn't want to break, and everybody got their summer rally going into Independence Day here, you got to know when these bottoms are in. You got to know when these tops are in. You got to know when these things are deflated. You also got to know when they're inflated. And you must know that this 1340 put, we're all over that. And we will continue to monitor very carefully, because these kinds of great trades only come around every now and then. And it's not like it's an everyday event. Yes, I can teach you how to trade them on a daily basis, but they're only going to be a daily entry and a daily exit. But the longer term cycles come at extreme tops, at bottoms when they don't fail, and that's why the call, $1,300 call right here, went up. This is how everything works. Learn how to master index options on the NASDAQ 100, the S&P 500. There are sector indices, such as all of these sector indices. We have sector U.S. indices that we cover with live analysis under sector indices. You can trade calls and puts. When these things were extremely overbought, you could have been buying the put side for the short side. When the materials, when the gold and the silver, and I'm going to be going through all of these today, all of these sector indices, some have calls, some have options, some don't. But then again, we want to take a look at the short-term cycle patterns that have happened here and how the S&P has broke, how the NASDAQ comp has broke higher. I will be doing some live videos for you, so you'll have that there. Those really pay 2 times more than the S&P. So when the NASDAQ 100 wants to rally in the heavily weighted tech and internet sector, great place to have call options on the indexes, great way to hedge portfolio, great way to hedge price action volatility in case you're short. They want to move the other way, it's okay, close out the short and let the long run and let these run. I'm going to conclude the video now. I will answer all the questions in depth with my S&P analysis on how to trade index options off the video with MMTs. Leo, do you feel that you have, because you weren't here for yesterday's training, so I've updated you.
Fantastic.
Okay.
That's fantastic. I really appreciate it.
Awesome.
It is. And it's awesome because when markets are going to have the moves, it's knowing everything about the bottom, it's knowing everything about the top, the characteristics, the seasonalities, and there's lots of things that play into the ingredients. When you're going to make an apple pie, you surely want it to taste good, and this is how you make one of these apple pies taste extremely good, because now that we have run this pendulum, I and you are going to be monitoring that this is the side of the market to be looking at. This side's going to get inflated in the cycle. Okay, the S&P could go right back up to 1370, and these could come down to $5. We don't know what Tuesday brings. We're not here to say that. What we are here to say is that we're going to hit a bottom on this contract, and we're going to hit a high on that contract, and we're going to put on a trade.